Well, the Bank of Canada decided to hold interest rates unchanged at 5% for a third consecutive meeting today. The central bank kept the door open to further rate hikes, but markets are expecting that the next move will be lower. For more on the future of interest rates in this country, let's bring in Dominique Lapointe, global macro strategist at Manulife Investment Management. Dominique, thanks so much for joining us this afternoon.
Pleasure.
So what did you make of the message, the tone overall that came from the Bank of Canada today and its statement?
Yeah, every sentence in that statement read incrementally dovish relative to October, right? So in terms of growth, what we've seen since the end of October is that every segment of the economy is becoming a bit weaker. So consumption is stalling, but across many segments, it's actually declining. And a lot of consumption comes from staple goods right now. And then you have housing that have started to roll over. And on top of that, business investment weakened in Q3. And then you add up 2 months of inflation that actually on a momentum basis is very close to target. So it's no surprise that they're very close to explicitly saying that rate hikes are over.
Yeah, it's interesting. Do you think that the Bank of Canada meant to come across, that dovish as you're sort of describing there, or that it would prefer to sound more like that last paragraph of its statement when it talked about how it is willing to raise interest rates further if necessary? Would it rather the focus be on that markets don't get ahead of the central bank in pricing in those rate cuts in the spring?
Yeah, well, in terms of the market, it's already probably coming ahead of what the Bank of Canada would like in terms of pricing in the cuts. And if you look at the 5-year Canada bond yields too. But I think when you read statement by statement, it's almost step by step, right? Where they sound incrementally more dovish, but they had to leave the tightening bias in there in terms of the message they send to consumer that rate cuts are not coming soon and that they don't want to create a rebound in debt loading for Canadian consumption, and also prevent a rebound in segment of the core inflation.
Yeah, but with markets expecting those cuts to be coming and the conversations talking about cuts and all of this, do you think that Canadians are going to be listening to that and thinking, well, maybe I should line up that house purchase in the spring, or, what have you?
In terms of guidance, I would say to be cautious, but not in terms of the rate cuts, because we do think that the rate cuts are coming maybe as early as March, but because we think that the economy will continue to slow and labor market conditions will deteriorate. And so in terms of planning decisions for spending, for vacation, people need to be aware that next year might be a tougher year. And that's why they need to make those decisions in light of that, not in light of maybe rates will be lower a year from now.
Interesting. Okay, so trying to, focus on the slowdown in the economy instead of what that might mean for people. Just how slow do you think that the economy will get? Are you expecting Canada to, suffer a recession of some level?
So the word recession always refers to 2 consecutive quarters of growth, and we've almost had that Q2, Q3, but we had upward revisions to Q2, so we didn't have that. There is a possibility that Q4 comes in negative, and then you'd have those 2 quarters. But beyond that, I think what our forecast is that next year will be very weak. On a per capita basis, it's actually very weak. You can actually qualify that as a recession when you divide GDP per capita, and that's why that is our message. But that being said, when we're also talking about the contraction, if central banks do follow suit with rate cuts, we're not talking any sort of contraction that we faced in 2008, 2009, or even 2020. We don't see any of those large imbalances in the economy, which would create massive unemployment like we faced before.
Yeah, we did see the unemployment rate tick up a bit. What is your sort of expectation for unemployment in that scenario?
there's sort of two dynamics in the Canadian labor market right now. And one is that the labor force, it's not new at this point, its labor force continues to grow very rapidly. So we're facing an unusual situation where the unemployment rate rises while employment is still growing, mostly driven by public sector jobs, but still. So there's this dynamic. The other dynamic is that employment growth has slowed. We barely created any private sector jobs since June. And we think that, unfortunately, as we go through next year, when you look at the business guidance and the business outlook survey, what they think about sales and their outlook, we'll face lower hours available. And for some industries, the most sensitive to interest rates, such as manufacturing, construction, maybe the financial industry, we could see more layoffs. So the unemployment rate, unfortunately, will have to raise a little more before it can start to slow down, as the Bank of Canada is sort of forced to ease policy in the first half of next year.
Just to come back to that statement today from the Bank of Canada, it did remove a line that it had added in the previous statement about increasing risks that it was seeing to inflation. Do you think that there still are significant upside risks to inflation that the Bank of Canada, could face in the months to come in getting it down all the way to that 2% target?
There are a lot of risks to inflation, but the problem for the Bank of Canada, and to their credit, they've recognized that, is that most of them they don't control. So if we've had lower energy prices over the past month, and it's been quite surprising, but nothing prevents oil prices from shooting up again, depending on the global context, and that will drive up straight energy inflation, but also has indirect effect on other inflation components. And the Bank of Canada, unfortunately, doesn't control that. There's an element of shelter inflation that is being driven by interest rate hikes that the Bank of Canada doesn't control, and also food prices that could go back up if weather doesn't collaborate next year. So they know that, and I do think that's why they increasingly, they very increasingly rely on their core measures to assess where inflation is going. And so over the past few months, it's been going in the right direction.